Hello?
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 Guys, can you hear me?
Yes, now I can.
I can hear you.
Okay. They can hear me, Mark.
So now we can attend this. I've been trying to get some help on the phone or anything to hear you.
Well, I mean, but you can hear me now?
I can now.
Okay. Mark?
Probably going to have everybody's unmuted right now. So
All right, wait a minute. Everybody just stay unmuted. If that's the way it works, that's the way it works. All I care about is that you can hear us.
Yep.
Mm-hmm.
I'm going to start from the beginning. Okay.
So apparently we had some technical difficulties before, not sure what people heard. So my name is Rich Hershen. I'm a partner at Gray Gray & Gray who heads up this group, and my colleague and partner Mike Coppell has been getting into some of the tax stuff. So I'm going to quickly turn it back over to Mike, and he'll dive right in and get everybody up to speed of where we're at.
Okay. Basically, you downloaded hopefully the handouts, which means you have all of my contact information. I have no problem with people emailing me and or calling me either on my direct line, or I give you my cell phone number so that you can have it if you want it. We expect an awful lot to happen in the next 60 to 90, maybe 120 days in the tax arena. So if you have questions as things are happening, please feel free to give me a call or give Rich a call. Again, those of you that didn't hear it, I try very hard not to be political in my presentations. It's a very hard thing to do, but I will try and do that. You can feel free to make any political comments you feel like, get whatever off your chest you feel like, but I'm going to try and avoid that. First thing we're going to talk about is PPACA, which you guys know as Obamacare. What is important to realize from our point of view at this juncture is that Obamacare is the largest individual tax increase in the last 20 years. All right, and we're going to talk about why that is true. All right, the other thing you have to understand is there is still a great deal that we don't know because of the uncertainty of whether or not the legislation was going to be overruled by the Supreme Court. The IRS and the Department of Labor didn't issue any regulations because of that, and therefore they're kind of behind. But we expect to see a lot more information shortly. We have a great deal of information courtesy of the Joint Tax Committee, which is a fairly authoritative source, and we're going to be using that. One thing this legislation does is it defines who is a high-income individual, at least for this legislation, for tax purposes. First thing you have to understand is we need to define a term called adjusted gross income, AGI. AGI is the number on the bottom of page 1, the front page of your tax return on the lower right-hand corner. That's your adjusted gross income. If that adjusted gross income is, and you're single, is over $200,000, you are, for this purpose, a high-income individual subject to these taxes. If you are married filing joint, it's $250,000, which means that if you are married filing joint and you have two incomes, and, for example, each of them is $150,000, you are a high-income couple, right? Even though neither of you reaches the single adjusted gross income of $200,000, you are subject to what we in the tax area call a marriage penalty. And I will, as someone that has been happily married for over 39 years, I'm not going to say anything about marriage penalty. First new tax is a tax on earned income. And this is a tax of 0.9%, an additional 0.9% tax on all earned income in excess of $200,000 single or $250,000 for married filing joint. This is projected to raise just under $87 billion over the next 10 years. You're going to hear the term 10 years bandied around a lot. That is basically what Congress uses when they're measuring the budget deficit time frame. Right. This almost $87,000, when you hear projections about deficits and everything else, this is already taken into account. Second tax is a tax on investment income. We'll define investment income in a minute, but look at the number we're talking about here. We're talking about in excess of $123 billion over the next 10 years, again, for people with investment income, and I hope that includes all of you, right, on your high income. That's the amount of investment income in excess of AGI of $250,000 or your investment income, whichever is lower. Right? For example, let's suppose that you have interest and dividends of $20,000 and your married filing joint AGI is $260,000. So even though you have $20,000 of investment income, your AGI is only $10,000 over your high income amount. You're only subject to $10,000 of the 3.8, or it's going to be 3.8%. If, on the other hand, your AGI was $290,000, you'd be subject to the investment interest tax on the entire $20,000. Now, I want to talk a little bit about S corporations. I know a lot of you and a lot of professional companies are S corporations. It's a very common way of professional companies doing business. What is very important here is how much you take as a salary from your S corporation and how much you take as a distribution of income from your K1. This is important because the income that you take from your K1 as an income distribution is not considered self-employment income and is not subject to the 0.9%. That which you take as salary on a W-2 is considered self-employment income and is subject to the 0.9%. One of the things that I have been recommending to people, is because this new law starts in 2013, I want people to try and take a look at their 2012 amounts, and if they're going to have earned income well in excess of the high income amounts, start to lower that back so that there isn't a huge difference in 2013. Try and minimize that amount in 2013. Theoretically, the IRS can come in and say whether or not you took what is considered reasonable compensation from an S corporation. And one of the tests for reasonable compensation is how much you've taken in the past. So we want to start establishing that trend as early as we can. If you are a partnership or an LLC or LLP taxed as a partnership, we have another little thing that we can do. A general partner or a managing member of an LLC, a managing member or a general partner, that portion of their income is considered to be self-employment tax. A limited partner or a non-managing member, that portion of their income is considered to be not self-employment tax. And therefore, we can do the same thing. We can manage how much that self-employment income is, and we can manage to a certain extent through bifurcation, which means that you would have an income as a managing member and a non-managing member, or a general partner and a non-general partner, or a limited partner. We can manage how much self-employment income you have, and we can manage how much is subject to the additional 0.9%. I'm assuming that everyone on this call works in their company and therefore is what we call active. If you are not active, or you have people that are passive, that do not work in the business but are passive investors, we have to be very, very careful with them. I don't want to get deeply involved with them. It doesn't affect the 0.9%. It's going to affect the 3.8% when we talk about that in a few minutes. We talked about investment income. This gets really, really tricky. Investment income is defined as interest, dividends, rents, so that basically if you own your own building and you are paying rent from your building partnership to your operating partnership and you have income there, that will be considered investment income. It is rental income, and it's going to have an additional 3.8% if you're a high-income person. Royalties and annuities. Now, we have a little trick which you may or may not want to do. And this is a quote that comes from the Joint Tax Committee explanation. And what it says, and we have to pay very close attention, investment income is the sum of gross income from interest, dividends, annuities, royalties, and rents, paren, other than income derived from any trade or business to which the tax does not apply, close paren. What we believe that says is that if you have investments, right, stocks, bonds, mutual funds, money market funds, CDs, whatever, and you hold them personally, then because you hold them personally, all of the income from them, interest, dividends, whatever, is going to be subject to the 3.8% if you're a high-income wage earner, which we hope all of you are. However, if those investments are held within your business, then it will not apply. Now, I'm not recommending you do this. I'm not telling you to do this. A lot of people are going to tell you not to do this because it subjects those assets to potential loss and litigation and so on and so on. I'm just pointing out, if you want to avoid the additional 3.8%, this possibility does exist. It is something that you really have to sit down, talk to your financial advisors, talk to your accountants, talk to me, talk to Rich, see if it makes sense for you in order to shelter that 3.8%. Now, the only thing I want to remind you is this is effective starting 1/1/13. So that if you want to do this, the time to start thinking about it, is really now. We're getting very close to the end of the year, and we should be planning for this. Now, I am a financial advisor. If you saw all my initials, I have a financial advisor initial, which doesn't mean anything, so I have to be a little bit careful in what I say here. I am not giving you financial advice. All right? Now, that being said, what is very important to understand is that capital gains, the gain on the sale of property other than property held in a trade or business that is not passive, so for example, you that are active in your business, if you sell business property, it is not subject to the 3.8% on the capital gains. All right? That's very important because a couple of days ago, the Wall Street Journal had an article. And basically what the article said is that if you sell your business, you should sell your business this year. It was on page B5 if you want to go back and look it up on November 1st. If you sell your business next year, you would have an additional 3.8% on top of whatever the capital gains rate is going to be next year. That is wrong. I spoke to the author. I told him why he was wrong. He looked it up. He admitted he was wrong and is not going to do anything about it. However, this is the important thing. And once again, this is directly from a direct quote from the Joint Tax Committee. In the case of the disposition of a partnership interest includes partnerships, LLCs, LLPs, anything that is taxed as a partnership, or the stock of an S corporation, gain or loss taken into account only to the extent gain or loss will be taken into account by the partner or shareholder if the entity sold all of its properties, blah, 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 which basically says to a tax person, as long as you are actively involved in a business and you are selling a partnership interest or an S corp interest, it will not be subject to the additional 3.8%. Notice the thing that is not included here. If you are a regular corporation, a C corporation, and you sell the business, it will be subject to the additional 3.8%. Right? But this is right out of what's there in the Joint Tax Committee. It is very, very important. If people are advising you that you should sell your operation to avoid the 3.8% tax, unless you're a C corporation, that is absolutely wrong. Right? And that is very, very important. Now, with regard to other capital gains, again, I don't want to give you financial advice. I personally believe you do not watch the stock market every day. I believe that's a good way to get old quickly. The other thing I want to advise you is a lot of financial advisors are going to be advising people to do something called capital gain harvesting, which is different from what most people do when they talk about capital loss harvest offsetting. The reason they're talking about capital gains harvesting is to minimize that 3%, 3.8% tax in 2013. One very important point that people do not understand is many people believe that a wash sale, which means that you sell an asset, you sell your IBM stock, for example, you sell your IBM stock and that you can't buy it back. That is not true. That is only true if you sell it for a loss. If you're selling it for a profit, you can buy stock back immediately, which is very, very important. One other misconception that people have is that you can avoid this new 3.8% tax through the use of trusts. That is also incorrect. Right? Basically, this applies to trusts as soon as trusts reach income of around $12,000. All of that investment income is going to be subject to tax. Trusts don't work. There was an article earlier in the year about that, and it was also wrong. It is clear that they do not work. I don't know how many of you have, now, I'm not using the word employees, I'm using the word W-2s. If you have more than 250 W-2s, if you're a fairly large organization, you have a new reporting requirement starting with this year's 2012 W-2s. And what you're going to be required to do is you're going to be required to report on the employee's W-2 how much health insurance you provided, not how much you paid for, but the total amount that was provided to the employee. Now, what we have done, and I would like to be able to say that we wrote it, we didn't. We took it from Commerce Clearinghouse, which is a publication company that does lots and lots of tax stuff. And what we've done is we've taken their work, which they did, and if you download it, you'll see their logo and everything else is still on it. And we've put it on our website so that you can look at it and download it. And it provides in great detail what is included as health insurance that has to be included, what is not included as health insurance, and what you have the choice to include as health insurance. Also on that particular PDF download is a detailed explanation. We get a lot of questions as to what do certain boxes of a W-2 mean. CCH also provided a really, really good explanation of each box, what it means. That's also available. I'm not going to go down this line by line. You can read it as well as I can. But basically what you have to remember is that it is not 250 employees. It is 250 W-2s. It is required information to be provided to the employee and to the IRS. Your employees, when they see this, are going to come to you and say, why are you doing this? Does this mean it is taxable to me? And the answer to that is, no, it is not taxable to you, the employee. It is still, health insurance is that provided by the employer is still a tax-free fringe benefit, but as part of PPACA, part of Obamacare, this was added that this has to be disclosed so that the IRS can keep track of it. Quite honestly, we have no idea why they want it, but as of now, this is something that they are looking at, and all we're concerned with is making sure that you comply. This PDF, which you can download, really provides a really good outline as to what you have to calculate and include on your W-2 if it applies to you. Now, the really contentious part of Obamacare, and you're starting to see more and more articles in this area, is what's called the employer mandate. We are not going to talk about the individual mandate. As far as I'm concerned, the individual mandate is not a business concern. It's an individual concern, and whatever it is for the individual, it is. The employer mandate is very, very important, depending upon what you decide to do. If you don't already provide health insurance for your employee, this can get very expensive very quickly. This is also where there's a lot we don't know. The employer mandate, the requirement to provide health insurance for those employees actually starts in 2014. However, what is important here is we have to start taking care of who we're going to provide it for starting in 2013. The reason we have to do that is we have to determine whether or not we qualify to have to provide employees with health insurance. And in order to do that, we have a couple of tests that we have to take. Test number one is, does the business have 50 or more full-time equivalent employees? If you own more than one company, related parties count. So the first question becomes, well, how do I determine when the full-time employees count? And basically what the new regulations that just came out recently say is that you can decide, you the employer, can decide when to start determining when those full-time employees count. You can do it up to 3 months before the beginning of 2014, up to an entire year before 2014. So basically what we're telling people is we have to go and start looking, starting at the beginning of the year, when we want to start counting to determine whether or not we're going to have 50 or more full-time employees. There's one other thing you have to remember. And some of you may have seen some articles about this recently. A full-time employee is not what you think it is. Most of us think of a full-time employee, well, in my case, it's about 60 hours a week, but most of us think in terms of a full-time employee as either 35 or 40 hours a week. That's what we think of as a full-time employee. That's not what the law says a full-time employee is. The law says a full-time employee is any employee who average work week is 30 hours or more a week. So that that basically, think about what that says. If somebody works 30 hours or more on average, they're considered a full-time employee. When we determine whether or not you have more than 50 full-time equivalent employees, you take all of your employees, you take all of their hours, add all of their hours together, divide by 30 to determine whether or not you have more than full-time equivalent employees, which is a little bit strange in the way you have to do that. But what is important here is that we really have to start in 2013 making this calculation to determine whether or not we're going to have to provide insurance in 2014. Now, those of you that read business publications, you may have seen that there is a lot of discussion, especially in certain industries. The most recent article I read was one in the restaurant industry. We see it in the restaurant industry. We see it in the retail industry. We see it in the staffing industry and several other industries. And what people are talking about doing is they're talking about cutting the hours of their employees and making all of their employees part-time employees. The reason that they're doing that, all right, I'm going to come back to this. The reason that they're doing that is because when we determine what the penalty is, it only applies to employees that work 30 hours a week or more. If an employee works less than 30 hours a week, you don't have to provide them with any insurance. They will have to get them from the exchanges, which here if you're in Massachusetts, we call our exchange the connector, all right, which we already have. And basically what the employees will be doing is they will be going to their exchange, their connector, in order to buy insurance. Now, a couple of things you have to understand. Step one is there are two things that you have to do if you are providing insurance. The first is that you have to provide what is called minimum essential coverage. Now, if you're a Massachusetts entity, you may have heard this term before. We in Massachusetts, in our health care law, already have a definition of minimum essential coverage.
Mm-hmm.
The federal definition...
I tried to. Why, how many
What?
times did it print?
Hello?
I'm sorry.
No, okay. We in Massachusetts have a definition of minimum essential insurance. Our definition in Massachusetts is actually higher than the federal definition. As of today, we don't know what's going to happen here in Massachusetts, whether or not Massachusetts is going to follow the federal rules or the Massachusetts rules. There are a few other states, actually there are 4 other states that already have required health insurance, and they're in a similar situation to this. So that's number one, is you have to have truly essential insurance. One of the things you cannot have is something that's called mini-med insurance. I don't know if any of you have heard that term. What mini-med insurance does is mini-med insurance puts caps on things. So that basically what we see in most insurance, for example, in the insurance that I have, I pay a high amount of coverage. I pay the first $1,000 of insurance I am responsible for, and everything after that, the insurance company is responsible for. A mini-med works the opposite. What a mini-med says is, I'm going to cover the first couple $1,000 of insurance, and everything after that is the employee's responsibility. As of 2014, those are no longer legal. Right? That's number one. The second requirement for insurance is that the cost of the insurance to the employee can be no more than 9.5% of the family income. Now, your immediate question is, how do I, the employer, know what an employee's total family income is? They may have a second job, their spouse may have a job, they may have investments, whatever. So what the government said is, all right, we're going to say that if you don't know the total amount of family income, you can use the employee's W-2 amount, which is obviously less than what the family income amount is going to be. And pretty much, since we're not allowed by law to ask the employee what their other income is, then basically we're stuck with 9.5% of the family income. Their contribution, the employee contribution, cannot be more than 9.5% of their W-2. Otherwise, we have a penalty situation. So what is the penalty? Penalty situation is $2,000 per full-time employee. And a full-time employee, as before, is any employee that works 30 hours a week or more, except the first 30 full-time employees you have no penalty for. So we have what I call the 30-30 test. The first thing we have to look at is, does somebody work 30 hours or more? If they do, then we have the next test. The first 30 full-time employees, when you determine if there is a penalty, there is no penalty for. So what does that mean? If you're an organization with 25 full-time employees, you have no penalty. Whether you provide insurance for your employees or not, there is no penalty that you incur. If you, for example, have 50 full-time employees, the first 30 are free, you have 20 left, you have 20 employees at $2,000, your penalty is $40,000. On our website, I don't think it's up yet, it should be up later this week, we have a spreadsheet that basically walks you through this, so that if you want to use that, you can determine which is going to be cheaper, whether it's cheaper to give your employees health insurance. And remember that we're only talking about single health insurance. You are not required to pay anything above the single amount for family coverage. All right, but our website will compare how much it costs you for insurance versus how much your penalty is. There's one more thing about the penalty. It is a penalty. It is not a deductible penalty. This is a non-deductible penalty, which means that it's actually worth a lot more than that because you lack the tax deductibility of it. So you have to kind of divide it by 0.6 to see how much it would actually be as if it were the cost of providing health insurance. Okay? And again, we have an estimator on our website, or it will be up shortly on our website, to help you determine which way is more efficient. I want to talk very briefly about an extraordinarily complicated area and one that is going to cause a great deal of grief and aggravation to almost all businesses and may provide an opportunity in your area. And that is the new proposed repair rules. And there's something that something I want to point out here, and this only is important to tax idiots like me, and that is that these new rules, which came out in December of 2011, came out as both proposed and temporary. Proposed mean that they put them out there and expected people to comment on them, which many people have. But temporary said that we don't care what comments people make. They're effective as of January 1st, 2012. So the rules that we're going to talk about very briefly here are currently in effect. All right? A couple things you have to remember. Those of you that are in fairly large organizations, you have, when you buy assets, right, you buy fixed assets, you have several different ways of taking those assets and expensing them. You expense them over time, number one. You can decrease the amount that you have to capitalize using what's called Internal Revenue Code Section 179, and you've probably heard the term 179 thrown around a lot. There's a glitch in 179. In 2011, you were allowed to 179 or expense immediately $500,000 of assets. In 2012, that $500,000 decreases to $139,000 that you can immediately expense. In 2013, unless the law is changed, it declines to $25,000. So that basically what we're telling people is, depending upon what you purchased in assets, it may be important to time that purchase of assets in order to take as much advantage as you can about Section 179. The second thing that you can do, the third thing that you can do with regard to assets that you purchased, is you can take bonus depreciation. And bonus depreciation in 2011 basically said that for the vast majority of new assets that you purchased, you could take 100% bonus depreciation and expense them immediately. 2012, that bonus depreciation dropped to 50%. In 2013, bonus depreciation goes away. So basically what we're saying is, now all of a sudden we're seeing the amount of assets that can be immediately expensed is declining in 2012 and really declines very, very significantly in 2013. So we have to take that into consideration. The other thing, and this doesn't affect you unless you are leasing property, in which case leasehold improvements used to be able to have a 15-year life. Starting this year, unless the law changes, leasehold improvements, if you lease new property this year and you're paying for the leasehold improvements, instead of having a 15-year life to depreciate it, it's now a 39-year life. So basically what we're saying is, the new repair regs, which require more assets to be capitalized and depreciated, there are going to be more of them. Now, why is this important to you? First thing that comes to mind is there are organizations, and many of them are architects and engineers, have a certain division that is specifically dedicated to something that's called cost segregation studies. And I don't know if any of you are doing that. It's a very profitable and going to be even more profitable segment of that business. What it basically does is it takes new construction or refurbishing construction and breaks down the cost of that into different components that can be expensed over different periods of time. Right? It's a very common thing that people do when they're building new construction or refurbishing construction, right? Or doing major leasehold improvements. Why is it even more important now? I am not an engineer. I am not a construction person. However, I do know that a roof does usually not last for 40 years. That's how long a roof is going to be depreciated. Let's assume that a roof actually lasts 20 years, which is about what I'm told they last. So let's suppose that I have a roof on a fairly large building, right? And it's been in use for 20 years, and at 20 years I have to put a new roof on. I have no idea how much the new roof costs. It costs $100,000. I know new roofs that I see cost more than $100,000 for commercial buildings, on big box stores, for example. So what happens is, under the old rules, what would happen is, because the roof was part of the entire structure, you were not allowed to do anything with regard to that disposition. What the new rules allow you to do is, the new rules say that you can take a reasonable estimate of the original cost of the roof. Don't ask me how you do that. I don't have any idea. It's not my field. But you could take a reasonable estimate of what it would have cost when it was put in, take that amount of depreciation, so let's say it's 20, let's say it originally would have cost $100,000. I've gone 20 years out of the 39 years, which we'll call 40. So that's 40%. It's $50,000 worth of depreciation. Because I'm putting an entirely new roof on, I can immediately expense that remaining $50,000 of remaining value. This is new. All right? For entities that do special work called cost segregation studies, and I've spoken to a couple of engineering firms that do it and a couple other firms that do it. And they tell me that this is something that they can do, that they can make that estimation. This is something that we are going to be looking for people that can do this estimation for, especially real estate people, so that we can recoup those expenses, which we would not have been able to do before. Now, the only thing that again, I'm not a cost segregation expert. What I'm told by those people that I know, that are friends that I have in the industry, tell me that the original cost segregation study probably doesn't exactly have this information, but if you still have that cost segregation information for a relatively nominal amount of money, the people that did it or someone else that is qualified is going to be able to come up with that information. All right? Tangible personal property, that's other stuff that you can touch other than real estate. All new rules, extremely complicated. Basically, I find that you guys do have a certain amount of computers, CAD work, other things that you buy and have. It is very, very important here as far as when you put something in, when you have something fixed, all right, when it's going to be expensed and when it's going to be capitalized. The rules basically are going to be sitting there and making you do more and more that has to be capitalized. It is something you really have to sit down and talk to your financial advisors, your tax advisors on. Now, I don't want to get into change in accounting method because we had the problem at the beginning. The issue that I do want to talk about is basically what the regulations now say is that most businesses, and I've been advising people for almost 40 years in the tax area, and we always told people to have a capitalization policy and to basically say that anything that's less than $1,000 or $1,500 or $2,000 or whatever, depending upon the size of the company, you should immediately just expense it and forget it and use that as a capitalization policy. One of the really unfortunate parts of the new rules, and one of the things that many people have said is just plain silly, is that the new rules say that a capitalization policy is now $100. So that basically anything that you buy that costs more than $100, or any group of things that you buy at once that's more than $100, you now have to take a look at and in detail look to see whether or not it has to be capitalized. And that's just a pain in the neck. Now, remember what I said. This is effective 1/1/12. Now, if I were the controller or CFO and whatever, and I knew that I had to do this, I would be very, very reluctant to do this with my company. It's a lot of work. So what I would say, and I am not advocating this, all right, but I'm saying that it is a possibility. One of the things that you can do is you can file what's called a Form 8275-R, which basically says, Dear IRS, I am not complying with these regulations. And you attach that to your tax return. I don't recommend it. It is something that you may or may not want to consider, and you should be talking to your tax professionals about whether or not you should, A, be complying with these new regulations, some type of estimate what it would cost you if you do comply, and what it would cost you if you don't comply. I would suggest you do that sooner rather than later. One of the things that you should know is that the IRS has indicated that sometime in the first quarter of 2013, they're going to be coming up with final regulations in this area. We do not anticipate any significant changes in this area, but there may be. One of the things that many organizations including the AICPA and several other organizations that we are members of and we've contributed to help write these, is that making this effective 1/1/12 was not wise. It didn't give people enough time, and it should be postponed till at least 2013 and more likely 2014. There is a chance that will happen, but we won't know that until first quarter of 2013. But we will keep you posted in that area. I want to talk about gift and estate. All right. Very briefly, we want to talk about gift and estate, and I'm rushing through this. We want to talk about gift and estate because the lifetime exclusion this year is just over $5 million for each individual, with a gift tax rate, a maximum gift tax rate of 35%. If nothing happens, all right, and you can have your own opinion as to whether we think Congress will get something done. If nothing happens, that lifetime exclusion drops to $1 million with a rate of 55% in 2013. So that basically what this says is that we really have to take a long, hard look if you're going to talk about making any kind of substantial gifts to your children, grandchildren, or me. You should be talking about doing that in 2012. Now, there is one thing that I will tell you is that if you're planning on making a gift of stock, of closely held stock in your entity or some other entity, you're going to have that valued. The organizations that are qualified to do valuations of closely held stock are very backed up doing that. If you're going to do it, you have to do it and contact these people, or have your financial advisors contact these people immediately. As I'm sure we're all now aware, President Obama has been reelected. His proposal, and that doesn't mean that's what's going to happen, but his proposal last February was that the lifetime exclusion be $3.5 million for an estate when you die. However, his lifetime exclusion for a gift was only $1 million. Now, once again, that was his proposal last February. We have no idea where he's actually going to go on this or what any negotiations are going to be. But this once again says we have to look that even if he would keep the gift exclusion as the same as the estate exclusion, we just lost $1.6 million of lifetime exclusion that is available to us, which really says we have to do something about any substantial gifts. We have to do that this year. I don't want to get very deep into this area, but one of the other things that the President has indicated in his proposal is he wants to eliminate what's called discounts. So let's suppose that you make a gift of some of your S-Corp interest in your engineering firm, right? And you go to somebody that's going to do a valuation of that gift, and they sit there and they say, well, you're giving away a 10% interest in your engineering company to your child. We can take discounts because of minority interest, it is less than 50%, and lack of control, because they don't control it, the 90% shareholders control it. Therefore, what we can do is we can take a discount, and it usually approximates 40%. Sometimes it's a little more, sometimes it's a little less, depending upon the person that's evaluating it in other situations. But think about what that does. What that says is that if I make a $12 million gift, and I'm married, right, that $12 million gift, because I'm taking a 40% discount from $12 million, I've got a $4,800,000 discount, which means my $12 million gift is only a $7.2 million gift, which means I have no gift tax because the husband and wife both agree to make the gift, and it's less than the $10 million. However, if the president's proposal goes through and there's only $1 million exemption and it applies for two, I've got over $5 million of taxable gifts. Right? This is why, again, we don't know what's going to happen. We have no idea what's going to happen, but doing something, and if you're going to do significant gifting, we strongly, strongly advise that you sit down with your financial advisor or your tax advisor and do something now. Same thing is true if you have grandchildren. Generation skipping tax is now $5,120,000 under the president's proposal. That exclusion drops to $1 million. One of the things that we talk about, and I don't want to use names, but let's take the Kennedys, for example, or the Rockefellers, for that matter. One of the things they did is they set up something that's called a dynasty trust. And that is why you see that multiple generations of Kennedys or Rockefellers always have money, and it doesn't seem as though, as it goes generation to generation, there is no gift or estate tax on it. That's because it was properly set up in a dynasty trust. And the dynasty trust allows those gifts to be non-taxable from generation to generation if they're properly done. One of the other things that is on the president's agenda is to eliminate that availability of dynasty trust for multiple generations. So if it is something that you want to do, once again, it is something that we advise you do sooner rather than later. One other thing that before I leave gifts and estate is there's a new concept called Wandry. And basically what it does is it is a mechanism called formula gifting, so that basically instead of gifting a specific amount of stock, 10% stock, like I gave the example before, I don't give 10% stock, I give a specific dollar amount. And what that does is if the IRS comes in and attacks the valuation, I'm still not going to have any additional tax. It is something that if you're doing major gifts, you want to make sure that whoever's writing up that documentation understands how to do formula gifting. Tell them about the Wandry case and make sure they're complying properly with it. If you're in Massachusetts, New York, Connecticut, California, I don't think there's anybody from California, but if you're from those states, we also have, for example, here in Massachusetts, a very significant state estate tax. And in Massachusetts, that state estate tax exemption is $1 million. Your state estate tax can be as high as 16%. So take, for example, all right, under current situation, let's suppose that the 35% current estate and gift tax rate stays the same. You die, you're taxed at 35% plus 16%, possibly in Massachusetts. Basically, you just lost 51% of your assets that your heirs would have gotten now goes to the federal government and to Massachusetts. And that applies to almost every state. Expiring and expired tax provisions, we talked about a few of them. The number is just enormous. One of the things that has expired and is not currently on the table is research and development credit. We've heard a lot of discussion. A lot of people say that R&D credits should be forever and should not expire. They have expired this year. They do not exist. The general consensus amongst tax professionals is that R&D credits will come back sometime during the lame duck session, that we will see them come back into play. Why is it important for an engineering and design firm? What we have to remember is that R&D credits begin in the design phase. So that depending upon what it is you're designing, if you're designing something that is new, that hasn't been designed before, it may qualify, you may qualify for the R&D credit. Now, there's another thing that expired with regard to credits, and that is that starting in 2010, one of the things that was passed in the 2010 Tax Act was the ability for individuals, you and I, to use credits, including the R&D credit, on our personal returns for alternative minimum tax. Right? I don't want to get too deeply into alternative minimum tax, but if you're here in Massachusetts or New York or Connecticut, you are very likely in alternative minimum tax, which means that in 2010 and 2011, if you had R&D credits or other certain types of credits, for example, if you had credits for green construction, right, because you helped design, for example, putting panels on buildings in order to take care of sun power, right? If you did that, there were certain types of credits that were available to you. During 2011 and 2010 and 2011, you could use those credits to offset your alternative minimum tax in addition to your regular tax. That is not true in 2012. Those credits are not available to individuals. They're only available to C corporations. So that one of the things that we have to look at is even if R&D credits come back, if you are a pass-through entity, if you're a partnership, or if you're an S corporation, getting those R&D credits or some of the other credits, and a lot of the energy credits have gone away, which we expect to come back. If those do come back, you may not be able to use them anyway. All right, so that there's an awful lot that we have to look at when we talk about what's going to happen. Now, I have a warning to people. R&D credits are considered by the IRS to be what's called a Tier 1 issue. A Tier 1 issue means that the likelihood of your being audited by the IRS is higher. So that, for example, one of the things that we see is that the percentage of businesses, right, that have either Massachusetts and or federal R&D credits or some of the energy credits usually have a higher percentage of IRS or Massachusetts DOR audits than other companies. That is not a reason not to do it. We have had great success in using very, very professional entities in helping determine what those credits should be. They do an outstanding job along with us in protecting them and in defending them. We just want to make sure that you're aware of that situation, that they are indeed to some degree, a red flag to the taxing authorities. One other thing that I want to make sure people are aware of, I believe, that there is going to be some significant tax reform happen in 2013. At this juncture, we have no clue what that's going to be. We still have a divided government. The Democrats control the White House, Democrats control the Senate, and the Republicans control the House of Representatives. At least that's the last thing I saw when I was looking on the net. So we have a divided government. Whether or not they will be able to come together to solve our financial difficulties, we don't know. One of the clear things that both parties have indicated is that our tax laws do need some reform. There is a committee already formed by our organization, the American Institute of Certified Public Accountants, the AICPA. There is an organization, we already have a group that has already been designated
Well,
to look at whatever that is and comment on whatever that is. We expect that would probably happen sometime in the second quarter of 2013. If you want to know more, you can sign up for our newsletters. We have ongoing webinars and seminars for all the things that are going to be happening in the next period of time. If you have any questions, we are open to discussion.
Let me just say, I know we're running a few minutes late. Apologize for the technical difficulties we had in the beginning. First of all, Mike, thank you. That was very informative and very helpful. Hopefully, all of you listening found that to be the same. If you do have any questions that weren't answered, or you think about something tonight and you want to learn more, please give me a call or send me an email. My contact information is in the slides. I think we'll leave it at that. So thank you for joining us, and have a nice day. Bye-bye.